Wes, very good to see you. I'm going to come at you with a question I know you get all the time. Should retirees include Bitcoin in their portfolio? And I'm asking because Fidelity recently published this white paper titled The Case for Bitcoin. So I'd like to talk through that paper, considering the price of Bitcoin is trading around 20 to 25% off its recent high. And the cryptocurrency recently halved. Can you explain what that means and how it changes its value?
Yeah, sure. So the Bitcoin halving is something that occurs every 4 years. In 2008, that was Bitcoin's inception. So there was a halving in 2012, 2016, 2020, and then here we are in 2024 and just had the fourth halving. So what that essentially means is if we were to think of Bitcoin as a digital treasure and you have people, which we'll call miners, that are seeking to find those Bitcoins, they're rewarded with Bitcoin for doing so. And that's done through computers and the network that Bitcoin runs on. Now, every 4 years when the halving occurs, the reward for Bitcoin is actually cut in half. So let's say that if you mined a one Bitcoin block in 2020, you were rewarded with 900 Bitcoin. Well, in 2024, that gets cut to 450. So
Hmm.
the halving is something that you would think, well, maybe that would be bad for miners, right? Because they're not rewarded as much for finding Bitcoin. But we can't forget the scarcity of Bitcoin
Right.
and the fixed supply that it has. So there's only 21 million Bitcoin that can be mined. We're not far away from hitting that cap. And if you compare that to how it works for gold miners, well, gold is a limited supply, but it's not as scarce, or doesn't have the fixed nature that Bitcoin has. So it's a very interesting thing. And to your point on the previous screen there, when you showed the price of Bitcoin, it's quite volatile.
Right. That's such an important point. So now let's dive in then to the Fidelity white paper, Wes, because I think a lot of people stay away from incorporating it because, as we are pointing out, it's very hard to understand kind of how it works and stuff. But let's get again nitty gritty, brass tacks. This comes down to money, right? So take a look at this exhibit from Fidelity. A 2% allocation to Bitcoin could allow for an increase in annual spending ranging from 1 to 4% and potential losses of up to negative 1% in a worst case scenario. And now for a 5% Bitcoin allocation seen here, that could allow for an increase in annual spending by as much as 9.5% for older investors, but with much steeper potential losses of up to 3% in a worst case scenario. So, do you think a retiree or pre retiree should incorporate Bitcoin into their retirement portfolio?
I think that this paper and the research behind it is a really good thing, and I'm glad that Fidelity put this out because it's important to recognize how maybe Bitcoin could play a role in a portfolio, and not just looking at how rosy it can be should Bitcoin's price of appreciation continue over the coming years, but also provide us with that worst case. What if Bitcoin went to zero? What if the adoption did not occur, like it seems like it has been and it will in the future? If that didn't happen and we had exposure to Bitcoin, would that kill a retiree's portfolio? And the answer to it, should you or should you not have it in a portfolio? There's a good argument that you really should, as part of a multi-asset portfolio, maybe
Right.
something to complement another commodity asset like gold, which many of us have in our portfolios. It can be just like Bitcoin can potentially be a good inflation hedge and a hedge against geopolitical events. And Bitcoin could certainly make a difference as far as what a retiree could spend throughout their retirement, more so to the upside than to the detrimental nature that could occur should Bitcoin go to zero. So we
Mm,
have to size this risk, Aaron, appropriately. Should it be a 50% allocation? Absolutely not.
Sounds risky.
And obviously, that wouldn't be a compliant thing to do or a smart choice to make as far as risk goes. But if it's a very small piece and it does really well, if it 10x from here or even more, that could make a sizable difference in spending habits and what you could do. But again, if it goes to zero, it's not going to, or at least it shouldn't, destroy your retirement lifestyle. And that's what's
Mhm.
really.
Mhm. So, of course, there's a perception that ETFs are less risky. And of course, Bitcoin recently has an ETF fund. It's gained more than 50% in April, some of which it's lost since, as money flowed into those new spot ETFs. So, can you quickly explain how investing in those spot ETFs is different from directly owning Bitcoin?
Well, it certainly makes having exposure to Bitcoin a lot easier than it was way back when.
Right.
So, even if you didn't want to buy the exchange traded fund, you could certainly go to an exchange such as Coinbase, directly buy the Bitcoin. You could transfer it to, a cold wallet, secure your own keys, and so forth. And if you're watching this, your head might be spinning like, "What are you talking about keys?" Well, the beautiful thing is with the exchange traded fund, it simplifies that. You don't have to worry about storing private keys, but you can participate in the good, bad, and ugly that Bitcoin is, right? So if the price goes up, as far as Bitcoin being measured in dollars, you participate in that. If it goes down, you participate in that. If it goes sideways, you also participate in that. So it's a very easy way to have exposure to it, just like you have exposure likely to the 500 largest companies in the US via an S&P 500 index fund. It's the same
Right.
kind of thing, or even a gold exchange traded fund. So again, I think it allows whether you're an individual investor, an endowment fund, a pension fund, it provides an easier way to gain access to Bitcoin.
So, are there any other questions investors should be asking themselves as they consider Bitcoin and their long term financial goals?
Well, one of the most important things I think it is to understand the volatile nature of Bitcoin. So it's a buy and hold asset. Be asking yourself, can I own something like this in my portfolio without getting too emotional with the swings that Bitcoin has? Because at the end of the day, Bitcoin is volatile. And if you're not careful, you can really hurt yourself by selling at points in where really it's probably another buying opportunity, perhaps rebalance your portfolio to enjoy the ride back up and play the volatility on your side. But just understand that volatile nature that Bitcoin carries. And then also, if your advisor isn't talking about Bitcoin or refuses to look into it and at least understand the risk and also the potential reward that could come with Bitcoin, then that's a question you need to ask yourself: is this the right fit? Because I think that it is a very accelerating asset class. It's a new technology, but it's something that we can't ignore because we are going more digital in the future, and I think we all know that.
Really interesting. Well, clearly, Wes, we are going to link to that white paper so people can read it on their own, but I'm sure they can come to you with questions. If they do have them, how can they reach you?
Feel free to shoot us a message, info@patriotwealthnc.com, or if you prefer, pick up the phone, 919-322-4113.
Great. Wes, thank you.